Hello and welcome to another in-depth interview brought to you by Livewire Markets. My name is James Marley. I'm a co-founder of Livewire and I'm joined today by Joseph Lai, who is the founder of Ox Capital, brand new, fresh off the shelf fund. And we're going to find out why he's inspired to go out on his own and learn a bit about the opportunity he's seeing in emerging markets. Joseph, great to have you on the video. Good to catch up and thanks for your time.
Yeah, thanks for yours, James.
Now, we're talking in a week where the headlines are being dominated by one of the largest Chinese property developers having some serious issues. I'm talking about Evergrande. And you're looking at launching an emerging markets fund. I just want to make sure, are you okay? Is everything, have you got your head screwed on right? Are you feeling okay?
Well, we can talk about the Evergrande situation a little bit later in the interview.
Okay.
But really, I mean, the reason why I started Ox Capital is, I've spent 17 years at, my old shop, Platinum. I'm managing, $7 billion and the performance was good. So the logical next step for me was always to build something, build a good investment organization. And that's been sort of like a dream of mine ever since I started in the industry about 20 years ago. And, furthermore, I actually think that with the experiences that I've picked up, we can actually do a good job. We can do a great job. And we can actually improve the way things are done. And the way how it's going to play out here in Ox Capital is that, we're going to focus solely on emerging markets in which Asia is vast major, like a big part of. We're going to manage, the market risks more systematically. And then, we have a team already assembled, which I believe actually have the relevant experience to be able to deliver that great performance. And so, what happened was, Fidante, also was looking to, into this area, and they believe in, what we're trying to do, and they wanted to be part of the journey. And we were quite, grateful for that because, Fidante has got a great, middle office and back office. So we know that, our infrastructure will be well looked after. So we believe, ultimately with the structure in place, the talent and the structure that we have is actually pretty special. I mean, it's actually pretty unique, not just in the Australian, funds management context. I mean, there's not many funds which are looking at this part of the market, but also the way we are doing things is actually quite special as well, quite unique relative to most emerging market funds you can find anywhere in the world. So we're excited, and then we are, very glad that we're getting started.
Well, we can dig into your process in a bit more detail, maybe with a few examples a little bit later in the interview. You mentioned you worked at Platinum for 17 years, but more philosophically, or just on your own investing experience, could you give me a flavour for how you do think about investing? What represents a good investment for you? What are you looking for?
The process is actually not that different to what I've always been doing, but I think I've made we've actually added some I guess improvements in the process. So if we take the one step back, right? If we think about what is sort of in shortage in the investment universe, for the next 5 years, I mean, I believe it's actually growth and pricing power of companies. So we'll focus. I mean, the focus of the fund would be on companies with a long runway of growth, with good management, and therefore have good pricing power. The reason why growth is in short supply is just because in most part of the world, there's a lot of debt. And with debt, it's actually hard to generate growth in these economies. And, the industries, the economies are, oversupply with capital. And so therefore, there's a lot of money chasing after, starting new businesses. So it's actually very competitive in most industries. It's hard to get the pricing power. So growth and pricing power. But if I may bore you to tell you what we do, because like most good fundamental bottom-up managers, we do something quite simple, but it's actually simply easier said than done. I will explain to you, right, what we do. So the first thing that we look for in the company is actually these long-term secular trends or themes, which are underappreciated by the market at the moment. So long-term themes underappreciated. The second thing we look for are good quality businesses which can be leveraged to these themes, right? And the third thing, now this is the important thing, and it's very hard to do. Do not pay up. Don't pay up. I'll repeat that. So first is, long-term good theme, underappreciated. Two, companies that, that you have confidence can deliver on the promise of number one. And three, do not pay up so that the valuation that you pay for can double in the next 3 to 5 years. So if you go work backwards, doubling in the stock price in 3 to 5 years implies like around 20% return. And that's sort of the 15% mark, 15% long-term, 15% a year. Long-term return is actually what the investment objective is for the fund. As I said, I mean, it's easier said than done. I mean, it requires curiosity to look for the news stories, the experience to know what is a good company, and the discipline to not chase the hottest story in town.
I know it's, as you mentioned, there's not a lot of product offering in emerging markets in Australia. So I'd like to hear what you think the compelling reason for people to invest in emerging markets is right now.
Yeah, look, I mean, I just think, this asset class is interesting for the next 5 to 10 years, because there's a lot of growth and there's a lot of quality companies, as I mentioned before. So it's all related. Next 5, 10 years is great, I think. Okay, so a little bit of information on emerging markets. So would you know that emerging market basically refers to stock markets of developing countries? So emerging countries already make up more than half of global economic output. And in terms of economic growth, it's like 60–70% of economic growth in the world. And of course, there's lots of people in these markets. I mean, there's literally billions of people just in Asia, right? So if we look at the MSCI emerging markets representation relative to MSCI world, it's like 12% of MSCI world. When the global output is much bigger, there's much more people in these countries. So what it tells us is that there's a lot of underinvestment in emerging markets. And going forward, there should be a lot of catch up to do. So that's interesting. And the second thing is this, the valuations of emerging market companies, the stocks are cheap. I mean, they're definitively cheap. We did a study, right? Before launching the fund, I mean, looking at the long-term performance of equity markets in developed markets versus emerging markets actually over the last 4 decades have outperformed that of developed markets by a long, long way. I mean, by a long shot. Last 10 years, however, has not been that story. I mean, we know the US market, the NASDAQ has been like this amazing, gone up 5-fold since the GFC. But it's interesting. I mean, if you go back to 2008, someone told you the NASDAQ is going to be the best performing, or, goes to 5-folds, you would not believe it. And I believe we're in a similar situation in emerging markets right now, where there's a lot of concern over various things. I mean, China is front of mind. There's other concerns as well. And this market is very cheap because of all the concerns. So that's why we're excited. And we're also seeing, because I've been looking at Asia for so long, I'm seeing the dynamism of the place just continue to push on. There's a lot of local companies becoming local champions. And because the market is, has been recently weak, we can find good companies growing at 20%, and they are literally on 15 times price to earnings multiple, long run of growth, good companies, and we're happy to get them. And it's, in a way, the starting valuation of the stock is often a good predictor of how much money you make of it. And I think we're in a very good place right now for the 3-5 years.
Joseph, you talked about the decade of underperformance in emerging markets. What specifically do you think was the cause of that underperformance, and why do you think it's going to change now?
Yes, sure. So it's interesting, right? So I also, over the last 10 years, the market has been choppy. And I have thought about this question for 10 years, managing money in Asia. So it hasn't been easy. But, we did actually good returns, actually, last 10 years. I think there are 2 reasons. One is that as China joined the WTO, and then they were growing like the clappers. I mean, literally, I think GDP in nominal terms must be growing at 20% plus in the early years. And the stock market got very excited for China and also for emerging countries. A lot of them are linked to China because they supply resources and what have you into China. And so if so the valuation, the starting valuation a decade ago was expensive for emerging countries, for emerging markets. So that's one, high starting valuation. The second reason is after the GFC, the big locomotive of the world and also emerging markets is China. They overstimulated, so they piled up a lot of debt, which all know about, and it's still taking them a little while, even now, to actually clear or reduce the burden. So now what we're seeing now is, I think, the last stage of this big sort of, I think, deleveraging, that's the term, or reduction of the debt burden for China. So that the last bastion of questionable debt, I think, is in the property market. They're hitting it right now. After this, I think there's not a lot of room for them to continue to deliver. So we're actually on the cusp of that, them clearing the deck for China. So that will turn. And so those two conditions, I think, would be in our rearview mirror as opposed to be in front of us. And the starting valuation is cheap.
In terms of particular themes or opportunities that you've identified and you're excited about, could you talk me through a couple of the high conviction areas that you're finding ideas, or some of the things that you think are exciting in terms of tailwinds?
The story for most of the emerging markets actually remain reasonably constant. I mean, it is actually the consumers and to some degree infrastructure for some of these economies. For the big elephant in the room, China, I mean, they have moved on, I think, from demanding more and more commodities and infrastructure and so have you. They'll keep building it, but the volume that they build won't be growing every year, which means demand for commodities is not going to grow that much, if not shrink a little bit. So that's behind us. Going forward, however, is actually, again, consumers or consumer-related stuff. So that would be the focus of what we look at. And I'll tell you 5 themes, and very quickly, I won't spend 5 hours talking about it because I can't. So the first one is healthcare. As people get richer, they want to look after themselves better, and the government would help that. Healthcare, insurance, internet, technology, and consumers. I'll talk maybe about 2 of them slightly more detail. So healthcare, I mean, if we look across the whole of emerging markets, particularly in Asia, people are getting richer. But if we look at the penetration of modern medicine, diagnostic machines, radiotherapy machines, and they call them linear accelerators, to shrink the cancer and stuff. In the bulk of Asia, it's underpenetrated. I mean, on a per capita basis, per population basis, there's a lot of room for modern healthcare, drug or devices in those markets. And the governments are allowing cutting edge devices or drugs to be imported into these countries because people want it. So that's a very, very interesting theme. And we're putting a lot of effort into that, looking for the best cutting edge technologies that can sell into the region. The other one, I guess I would stick with a slightly more boring theme, the consumers. Everyone knows about the consumers, but I want to tease out the nuances. It's not, to me or to us, to our team, it's not just enough to say the consumption is going to grow. Everybody knows that, right? Even people who are negative on China knows that consumption is growing in China, and they believe it. So we've done a lot of work actually to try to work out what is the mix of the products that are changing. So what we found is that there's a rising demand for the more differentiated consumer products, particularly for the for younger people. So that's not me, but that's probably not you either, but James. But it's more the Gen Zs. They still like luxury goods, but there's a greater willingness to actually embrace their own domestic local brands. There's a greater willingness to go onto the domestic websites that are specifically catering for them. So the young, Gen Z's tastes in Asia is not different actually to most other Gen Zs in any parts of the world. But as you can appreciate, the taste is different to the baby, to us, right? Or the people older than them. So we're looking at that and looking for specifically at which opportunities are best to be slotted in into the portfolio to actually take advantage of the new trends.
On that consumption side, can you talk through some of the local brands and names that are appealing to that Gen Z audience? What are they buying? What's computer games and phones?
Yeah.
Is that what it is?
Yeah. Well, yeah. I mean, it's a little bit. It's about that. But I tell you, I mean, if you can indulge me, I'll tell you a little bit of a story. So when I first, 15 years ago, when I first started looking at Chinese consumer stocks, right? There's a lot of, sportswear companies, sports apparel companies, locally, right? There's a lot of them. In China, it's very competitive. There's literally like 50. And, and then they had no chance against the like of Nike or Adidas, right? Because everyone liked the typical, good brands, right? Nike, Adidas, represents, I guess, wealth and also the functionality of them, whatever. And the local brands were relegated down the bottom, and basically there's not much brand value. There's not much loyalty there. But it's a recent phenomenon. In the last 3 to 5 years, the young people growing up, they're actually embracing the local brands a lot more. I mean, instead, I guess people, who are middle-aged, would look at those brands like, well, that's like not a status symbol, right? The local brands. The Nike, Adidas, Louis Vuitton, or whatever, yeah, status. The young people are actually embracing the local brands in a much bigger way, and they're willing to pay up. I mean, they're paying like $200 Aussie for like one of those hoodies, right? With a local brand on it, which I could never have imagined, or I would never see, 10 years ago. So there's that idea, and also, there's some websites which the younger members of my team, we've got a big range of age group range in our team, and also different, backgrounds and language, and then also gender, actually. So it's very good. And they told me, look, that's what the people there are logging onto. This is the app they're using to share videos. I took a look at it. I thought, wow, this is amazing. Young people are doing that, and this company, which is called Bilibili, what a funny name, right? Bilibili. It's and in Chinese, it's actually sounded very similar. I mean, it's growing revenues by like 100%, and it's growing users by like 40%. I've never seen anything like it. And so I thought, oh, in this sell-off, that's the thing that I'm looking at, actually. And then actually I'm thinking, I've been buying it. So that's an interesting, so I guess it highlights some of this new like taste for services or products, which are particular for the new generation. And it's not just China, it's universal across the world that people have different tastes, and it depends on what generation they grew up in, and whether they've gone through the hard yards, or whether, like the current generation of young people in China, actually they haven't gone through the hard yards at all, right? Perfect, good, last 15 years, great.
It would be remiss not to talk about why China's cheap, knowing that it's not an exclusive China fund, but that's obviously where you're finding some opportunity. How do you manage the risk, and what are some of your views on those things that are happening right now?
I just think, not just for emerging markets, I just think in terms of investing, one has to skew the risk in our favor. Investing is basically, we are taking risk. I mean, when you buy a property, you are taking a risk, right? So if we can actually, in a way, skew the risk in your favor, that will help. And risk, so that's the foundation of investing and risk management. So go back to what I first said. How do we skew the risk in our favor? First thing, look for what is attractive. So growth and pricing power, we mentioned that, we'll focus on that. Second thing, be aware of which way the wind is blowing. So that's really able to contextualize what the company's going to do, what the government likes or dislike, and try to stay away from the ones with a lot of headwind. A little bit of headwind may be okay, but a lot, well, stay away. 3, do good work so that we can contextualize what's going on, and I guess maneuver around difficult problems. And 4th, and this is part of the investment process, do not pay up. And what it does is that once you've done the good work, you know what you're buying. And then if you don't pay up, you actually have a nice margin of safety. And that's important, that that protects your downside. And that is risk, right? What is risk? Is downside risk in most cases. And so you can do all that, and then okay, you actually have a good wicket, a good lane to move now. But the next thing is, well, what if after doing all that, can you be 100% sure that you are actually going to be 100% correct? You can't be, right? So the next thing is actually diversification. So to have names in various sectors and also countries, so that you are not going to be drawn into these sector risks or country risks in one go. There's benefit in that, but not too diversified. I reckon 30 to 50 names in your portfolio would be good. That's more than enough to diversify away those risks and look at the sectors they're exposed to. And then the second last thing is actually to have some way to tell you, to guide you where the true north is. And with us, we've got this quad model, which we've called a moat, which actually can tell us what is going on in the world, in the different economic sectors, in the different companies and markets, almost in one go. It sucks in 1 million data points at a time. And it's very helpful to have a sense of where the true north is. So you can actually try to, listen for the narrative that's in the market. You can actually, see what people are fearful of, and then look at what is the true north. And if that's different, it is actually a wonderful time for you to make extra money or reduce the downside risk. And that's what we'll do in the portfolio. That's helped during COVID when everyone's concerned. We were not. When everyone's not concerned, we were at the beginning of COVID. So the last thing is ESG. ESG is integrated in the process. And so we want, and I believe in it, because one safety one thing that can protect investors from really bad idiosyncratic risk is, good governance and social license to operate the business, right? So a good ESG company will not give you the headaches that some of the very dodgy companies would. And over the years, I've seen actually companies, especially in emerging markets, when they improve the ESG credential, they actually do better. So we can do the right thing at a time, do the right thing and also make money at the same time. Why not?
Well, Joseph, I know you told me when we were getting ready that you've been working 20-hour days to get the fund up and firing. Best of luck on the journey that you're about to undertake, and thanks for taking the time to talk us through some of your views, your thoughts, and where you're putting some money to work.
Yeah, thanks very much, James. It's been great to be given the opportunity to communicate with clients and your audience. Thank you.